Last year, 47% of Buy Now, Pay Later users missed a payment. That's not a typo. That's nearly 1 out of every 2 people using apps like Klarna, Affirm, and Afterpay. 2 years ago, that number was 34%. In 2 years, it jumped 13 points. And here's the part nobody tells you when you split a $40 grocery order into 4 easy payments. The federal rule that would have protected you from this exact spiral was killed in 2025. Not by Congress, not by accident, by the one agency that was supposed to stop it. This is how it happened, and who it happened for. Meet Danielle. She's a dental hygienist in Tucson, Arizona. She makes $52,000 a year. 8 months ago, she opened one Klarna account to split a $180 car repair into 4 payments. That felt manageable. So did the next one, and the one after that. Today, Danielle is running 4 separate Buy Now, Pay Later loans at the same time, across 3 different apps. None of those apps can see the other 3. She owes $960 total, spread across 16 payments due on 4 different dates this month. She missed one last week. Her credit score dropped 19 points overnight. And there's a paper trail for this. By the end of this video, you're going to understand exactly how Buy Now, Pay Later companies built a lending system that looks nothing like a loan, until the moment it collapses on you like one. You'll see how these apps get you approved in 8 seconds without ever checking if you can actually afford the loan. You'll see how 4 separate BNPL loans can pile up invisibly because none of the lenders can see what the others already lent you. And you'll see the exact 2025 decision made by a federal agency under new leadership that made all of this legal on purpose. Here's the roadmap. First, we go back to how BNPL started as a checkout button and mutated into a grocery financing tool for 1 in 4 users. Then, we break down exactly how the lending model avoids the safeguards a credit card is legally required to have. Then, we show you where it's cracking right now, who benefits from that crack, and what it costs 4 different Americans living with it today. Here's the structural trap. You go to checkout online. A small button appears. Pay in 4, 0% interest. You tap it. 8 seconds later, you're approved. No pay stub, no proof of income, no hard credit check that would show up on your report, just a soft look at your credit file, the kind that doesn't ask, can this person actually afford this? And an instant yes. That approval doesn't check whether you already have 3 other BNPL loans open right now. It can't. Klarna doesn't share data with Affirm. Affirm doesn't share data with Afterpay. 3 lenders, 3 blind spots, 1 borrower quietly stacking debt that no single company can see. And in 2026, this isn't just for sneakers and flat-screen TVs anymore. 1 in 4 BNPL users is now financing groceries this way, up from just 14% a year earlier. People aren't using this to buy something fun. They're using it to eat this week and pay for it in March. But this wasn't always how it worked. Here's where it started. Rewind to 2005. A Swedish startup called Klarna launches with a simple pitch. Let online shoppers pay after the item arrives so they can check the fit before the money leaves their account. It's framed as a convenience for cautious shoppers, not a lending product. Fast forward to 2012, Affirm launches in San Francisco with a sharper pitch aimed directly at credit cards. No late fees, no compounding interest, just 4 flat payments. 2 years later, Afterpay launches in Australia with the same structure. By 2022, Block and the company behind Cash App buys Afterpay outright. Here's the legal move that made all 3 companies powerful. They structured these loans as short-term, 4-payment plans specifically designed to fall outside the Truth in Lending Act, the 1968 law that forces credit card companies to check your ability to repay, send monthly statements, and cap how aggressively they can come after you. A credit card issuer has to ask, can this person afford this? A BNPL lender, structured this way, never legally had to ask that question at all. That wasn't an oversight. That was the design. Here's what changed, and when. In May 2024, the Consumer Financial Protection Bureau, the federal agency created after the 2008 financial crisis specifically to close gaps like this one, issued a rule that said BNPL loans should be treated like credit cards under that same 1968 law: billing statements, dispute rights, refund protections. The BNPL industry didn't wait around. The Financial Technology Association, the trade group representing Klarna, Affirm, and Afterpay, sued the CFPB in federal court to block it. By March 2025, under new agency leadership, the CFPB and the industry it was supposed to regulate filed a joint motion asking the court to pause the case. By May 2025, the CFPB announced it would stop enforcing the rule entirely. And in 2026, the agency confirmed it has no plans to ever reissue it, calling its own 2024 rule, in writing, procedurally defective. The regulator and the industry it was built to watch ended up on the same side of the courtroom. That's the mutation, and that's exactly where the crack starts to show. Let's break down exactly how this machine runs, step by step. Imagine you're Klarna for a second. Your entire business model depends on approving as many people as possible, as fast as possible. At the moment, they're most likely to say yes. Standing at checkout, already emotionally committed to the purchase. A slow approval process kills conversion. A strict ability to repay check kills conversion even harder. So here's what you build instead. Step 1. A soft credit inquiry, a background peek at someone's credit file that doesn't ding their score and doesn't require the paperwork a mortgage or auto loan would. Step 2. An instant algorithmic decision based on limited data, mostly whether this person has repaid you before, not whether they can afford this new loan on top of everything else they owe. Step 3. Structure the loan as 4 payments over 6 weeks, short enough and small enough to dodge the legal definition of credit that would trigger Truth in Lending Act protections. 3 steps, 8 seconds, 0 visibility into what else this person owes. Now here's the part that turns convenience into debt. Loan stacking. Because Klarna, Affirm, and Afterpay don't share a common database, a shopper can open a $50 loan on one app, a $120 loan on another, and a $200 loan on a third, all in the same afternoon. And every single lender approves it because none of them can see what the others just did. The Richmond Federal Reserve, one of 12 regional banks that make up the Fed system, studied this exact pattern in 2026 and called it a forward-looking risk, meaning it's not causing a crisis yet, but the growth curve is the warning sign. Deep subprime borrowers, people with the weakest credit histories, already made up 45% of all BNPL loans in the years CFPB researchers studied. That's not a coincidence. That's the exact population a soft check, no income verification loan is built to reach because it's the population a credit card company would reject outright. The lender isn't gambling on you. The lender is betting that late fees and merchant transaction fees will cover the losses from the people who can't pay. As long as enough people who can pay keep using the app too. Here's the analogy that makes this click. Think of a credit card as a single water tank with one gauge showing exactly how full it is. One company, one statement, one number telling you your balance. Buy now, pay later is 4 separate buckets, each with its own tiny gauge, and none of the gauges talk to each other. You can look at any single bucket and think, I've got room. This one's only a quarter full. But nobody, not you, not any single lender, not even a credit bureau checking your file the old way, could see all 4 buckets at once and add them up. That's what changed in 2026, though. Klarna, Affirm, and Afterpay all started reporting to all 3 major credit bureaus, which means the buckets are finally visible on your credit file, but only after you've already missed a payment and your score has already dropped like a credit card late fee just hit. The transparency arrived after the damage, not before it. And here's the number that shows exactly how fast this mutated. In 2024, 34% of BNPL users reported missing a payment in the past year. By 2026, that number hit 47%. For Gen Z specifically, people currently in their early 20s, the number is worse. 57% have missed a BNPL payment. And Gen Z borrowers are already carrying $500 more in credit card debt than millennials carried at the exact same age. That's not two separate debt problems. That's one debt problem stacked on top of another, both invisible to each other until a bill collector isn't. The machine doesn't need every borrower to fail. It needs the 8-second approval, the 4-payment structure, and the invisible stacking to keep converting shoppers at checkout. Because volume, not individual repayment, is what BNPL companies report to their investors every quarter. The system isn't broken. It's converting exactly the way it was built to convert. Here's the part that makes the American decision impossible to defend as just how lending works. 8 days ago, on July 15, 2026, the United Kingdom did the exact opposite of what the CFPB did. The UK's Financial Conduct Authority, the agency that regulates lending across Britain, brought Buy Now, Pay Later fully under its regulatory umbrella, not a guideline, not an interpretive rule that can be quietly withdrawn, a binding legal requirement. Starting that day, every BNPL lender operating in Britain has to run a real affordability check before approving a loan, even on purchases under £50. They have to show a customer in writing before the agreement exactly what they owe, when it's due, and what happens if they miss a payment. And if something goes wrong, British borrowers can now take their complaint to the Financial Ombudsman Service, a free independent body Americans using Klarna or Affirm simply don't have access to. Same companies. Klarna operates in both countries. Same lending model, same 4-payment structure, two governments, two completely different verdicts on whether shoppers deserve protection. So here's the question. This contrast forces into the open. Was the American rule really procedurally defective, the way the CFPB claimed in its own paperwork? Or was it defective only in the sense that an industry trade group didn't want to live with it? Because Britain looked at the same lending model, the same missed payment data, the same loan stacking risk, and concluded borrowers needed more protection, not less. The UK's rule didn't kill Buy Now, Pay Later. Klarna is still operating in Britain right now under the new rules this week. The companies didn't collapse. They just have to ask one question before lending. Can this person actually afford it? That's the same question American regulators walked away from asking, not because it was impossible to enforce, not because it would have destroyed the industry, but because one country's regulator held the line and the other one didn't. Here's where the gap between the pitch and the reality splits wide open. The pitch from every BNPL company has always been the same. Unlike credit cards, we don't want you carrying debt. We want you to pay it off in 4 easy installments and move on. That's the entire marketing identity. Safer than a credit card, no compounding interest, no debt trap. But look at what actually happened once the federal rule requiring credit card-style protections got pulled. No mandatory billing statements, no guaranteed dispute rights if a product arrives broken, no federal requirement to check whether a borrower can actually repay before approving a 4th or 5th simultaneous loan. And the CFPB's own January 2026 research, before the agency's leadership softened its position, found exactly the warning signs you'd expect. Rising balances, rising credit utilization, and rising delinquency tied to BNPL use. Then, months later, a different report from the same agency, using a narrower dataset of only first-time borrowers, concluded there wasn't clear evidence of harm. Two reports, same agency, opposite conclusions timed conveniently around the decision to kill the rule anyway. That's not research whiplash. That's a regulator building the paper trail to justify a decision it had already made. So who actually benefits from a loan product with no federally mandated ability to repay check? Not the borrower splitting a grocery bill into 4 payments due on 4 different Fridays. Not Danielle in Tucson watching her score drop 19 points for missing 1 payment on a $960 balance she didn't fully realize she'd built. It's the Financial Technology Association, the trade group that represents Klarna, Affirm, and Afterpay, that sued to block the rule in the first place and got exactly the outcome it paid its lawyers for. It's the merchants who pay BNPL companies a transaction fee for every completed sale, because a shopper who can split a purchase into 4 payments is a shopper far more likely to complete that purchase instead of abandoning their cart. And it's the BNPL companies themselves whose revenue comes primarily from those merchant fees, meaning their business model is healthiest when as many transactions as possible get approved, not when borrowers are protected from overextending themselves. Here's the quiet detail that proves it. New York didn't wait for Washington. Governor Kathy Hochul signed the state's own BNPL Act in 2025, requiring these lenders to register with the state and follow fee and data privacy limits. Because the federal government had just walked away from the job. When a state has to build its own guardrail because the federal one got dismantled, that's not a gap, that's a receipt. Remember that 47% figure from the top of this video? The share of BNPL users who missed a payment last year? Here's exactly what that looks like in 4 different living rooms right now. Matthew is a warehouse supervisor in Columbus, Ohio, making $54,000 a year. He opened 2 BNPL loans in the same week to cover a $600 car repair and a $340 back-to-school shopping trip. Neither app saw the other. He missed 1 payment when both bills landed the same Friday as his mortgage. And his credit score dropped before he even knew there was a problem. Olivia is a nurse in Phoenix earning $71,000 a year. She uses BNPL specifically for groceries during weeks when her paycheck runs short. She's part of the 1 in 4 users doing exactly this in 2026. Her balance never gets large, but it never fully clears either. She's paid $340 in missed payment fees over 8 months for food she already ate. Tyler is 23, working retail in Denver, part of the Gen Z group where 57% have missed a BNPL payment. He's carrying $2,400 across 3 BNPL apps and 2 credit cards, $500 more in total debt than his older sister carried at his exact age. He didn't buy anything reckless. He bought sneakers, a phone case, and dinner with friends. 4 payments at a time, everywhere. And Danielle, back in Tucson, the dental hygienist from the top of this video, is still juggling 4 loans and 16 payment dates a month. Her $960 balance isn't the crisis. The crisis is that no single company she owes money to can see the other 3. Run the math. And this is what you find. Buy now, pay later was never designed to be safer than a credit card. It was designed to be faster than one, fast enough to skip the exact question a credit card is legally required to ask. Can this person afford what they're about to borrow? For over a year, a federal rule closed that gap. Then the agency built to protect you sided with the industry it was supposed to watch. And the gap reopened. This wasn't a glitch that slipped through. It was a business model that needed the glitch to survive, and a regulator that let it. 4 buckets, 4 gauges, none of them talking to each other. That isn't an accident of technology. That's the entire product. 47% of users missing a payment isn't a sign the system is failing. It's a sign the system is running exactly as it was built to run. Approve fast, split small, stay invisible until the score already dropped. The bucket was never too small for you. It was built so you'd never see all 4 at once. If this is the first video you've landed on, this is what we do here. The story underneath the story. Subscribe to American Ledger Journal. Hit the bell so the next one finds you. And if this gave you something worth passing on, send it to someone who needs it.